So some of the big news recently has been these private credit events that we've had with First Brands and Tricolor. One's an auto parts company, one's a subprime finance company, and we've had some multi-billion-dollar private credit bankruptcies that when Jamie Dimon was asked about them, he commented that I probably shouldn't say this, but when you see one cockroach, there are probably more. Now, ever since that statement, there's just been a rush of people out there trying to say that these are idiosyncratic events. So you do your own research. Let's. I think we're going to find out for ourselves whether these are idiosyncratic or not. But I lean more with Jamie Dimon. Let's go on to the next. So look, I've talked many times, and we've talked about the overvaluation of the record valuations of U.S. equities, of U.S. large cap equities, of the U.S. total stock market index at large, the Buffett indicator. I'm not going to talk about valuation at all today because I think the value argument has already been made, and there's too many people that just say, well, value doesn't matter. It's all about momentum, and it's about well, the earnings are still good with the Mag 7. I mean, never mind that in the internet bubble in 2000, the earnings continued higher in S&P 500 and the large cap tech stocks for the entire year, but the stock market did peak first. So what are some of the other factors that we need to be on the lookout for besides just valuation? Well, one thing is positioning, and this chart is from Goldman Sachs, and it shows that in U.S. equities, investor allocation to equities is at an all-time high. This is the aggregate financial asset allocation across households, mutual funds, pension funds, and foreign investors to U.S. securities, and it is the highest it's ever been. So positioning, overcrowded positioning. Let's go on to the next. Leverage. So Paul Tudor Jones was being interviewed on Bloomberg earlier, maybe it was last week or earlier this week, whenever it was, very recently, and he he said he was asked, is margin debt a problem in the market today? And he said, yeah, margin debt, but it's not so much margin debt. It's the leverage that's embedded in all these ETF products that we need to be concerned about. And look at the number of leveraged ETFs has just hit a record all-time high per this B of A investment strategy research piece here. There's a lot of leverage embedded in ETFs, but also he said options. The options markets are another place to be on the lookout for the embedded leverage. And nowadays we have these zero days till expiration options that are very crowded, and so it's something else to watch out for, because oftentimes these big market bubble peaking type events are a leverage effect, and it's the winding up with the leverage that creates the bubble, and it's the unwinding that's the catalyst, the reflexive catalyst for the bursting. But let's look at something else here, because margin debt in the next slide actually is a concern. We just saw in the prior slide that cash was at record low levels relative to bonds and equities, especially. But it's because people will say, oh, there's still all this cash on the sidelines. Well, no, not when you look at it relative to the amount that's invested in equities. But margin debt is also a problem, because when you have a high rate of change and high acceleration increase in margin debt, this is looking at the 2-year % rate of change, and you can see it. When you've had a high increase, 60, 70% increase over the past 2 years, these are the danger zone. We saw this back in July of 2007. That was an S&P interim peak. We saw it in February 2011 We saw it in February of 2022 during that early 22 market peak. So something to be concerned about. Let's go on to the next. Insider selling. Well, this is not a valuation indicator, but maybe it is. Maybe insiders are saying that things are pretty overvalued. I'm going to sell. And last week we had the top 200 insider trades were all insider sells. When Jensen Huang is aggressively selling in Nvidia stock, I mean, do I want to be a buyer? I don't know. Let's go on to the next. This was a great article, I think yesterday or the day before, in the Wall Street Journal that talks about the circularity of all these AI deals, and we've seen this going around on Twitter. But a really good article. I encourage you to read it, it really echoes of the 2000 tech bubble and tech bust, vendor financing circularity that we had. Back then, Lucent was kind of the poster child for vendor financing in the telecom internet boom and bust, and it did not end well. I'm not going to go into depth here. You can read the article for yourself. Let's go on to the next. So Jim Chanos, famous short seller, has been out there recently, talking about the AI bubble, and we've shown charts in the past that compare it to the 2000 internet bubble with the CapEx spending relative to GDP, and the hyperscalers are investing in GPUs and CapEx in these AI processors, largely from NVIDIA, and this is the H100 index for these big NVIDIA's latest greatest processors, and the rental index of these things is down 25% year over year. So this is a record CapEx binge into a depreciating asset. These are depreciating assets. Let's go on to the next. So Mohammed El-Arian retweeted this Torsten Slok from Apollo chart showing. I apologize, it's kind of small, but it's showing that the companies in the Russell 2000 that have negative earnings have been outperforming the companies in the Russell 2000 that have earnings. And Mohammed El-Arian's comment on this is that this can be seen as a broader phenomenon in which some investors are reaching further and further for returns, pushed there by widespread compression in risk premiums. So one thing we hear about this potential AI bubble, and I do think it is absolutely an AI bubble personally, we hear that it's different this time compared to the dot-com bubble because the companies have earnings and the companies still have earnings growth. Well, here's evidence, and the companies had earnings back then too, especially the mega cap tech stocks of their day. And like I said, those earnings continued to grow all through 2000, even though the market peaked before that. Yeah, sure, there were a lot of dot-coms with no earnings, but yes, there's a lot of companies, especially in the technology space, that have no earnings today either. And there's a lot of speculation going on in these names too. Let's go on to the next. So gold has come down a bit recently after a really great run year to date. Is the bull market over? Gold mining stocks have come down. look at the gold to S&P 500 ratio. We've shown this chart before. Tavi's shown this chart a lot, and in a lot of different ways. But we contend that that gold is absolutely not a bubble, and especially gold mining stocks. But just look at the S&P gold to S&P 500 ratio to get a sense of where we're really at there. We haven't seen anything yet. If you think that the bull market in gold, silver, and gold mining stocks is over and has reached a peak, we contend it's quite the opposite. The bubble is in the S&P 500 and the mega cap AI stocks, which are propping it up the most. But it's a broad U.S. equity stock market bubble, as we showed in some of that earlier data, and we believe very strongly in this. The pullback that we've had in gold and gold mining stocks and other metals mining stocks is an opportunity for those who've just been sitting on the sidelines all year to still come in. And let's look at that. Go on to the next. 39% of fund managers, according to the B of A Global Fund Manager Survey, own 0% gold. We just learned that 55% of all financial assets are invested in equities, and predominantly large cap U.S. equities. I mean, that's a record all-time high, but 39% of fund managers own 0% gold. So is gold the bubble? I don't think so. Let's go on to the next. So our funds, our strategies, we have two major themes across the firm. We are long precious metals and other critical metals, mainly through mining, through exploration and development and production stories across the whole Lassonde curve. But we also have a theme, especially that we're expressing in our global macro and long short funds, where we are short what we believe the bubble is in this Nassim Taleb black swan style trade, where we don't have to get the timing perfect. We're trying to get the timing right, but we don't have to get it perfect. It's much more about the setup and being there with the asymmetric risk reward type play that we have through the put options, primarily to the potential downside and from the bursting of these bubbles. And where is the catalyst going to come from? Is it going to be from trade wars and tariffs? Is it going to be from we don't really care where it's going to come from. Is it going to be a private credit event where these cockroaches start to come out of the cracks and crevices? Is it going to be a liquidity driven phenomenon? I mean, it doesn't matter. We can take the opposite side of all this momentum, crazy speculative risk, especially with the low premium, with the low VIX in the S&P 500, and we can roll those options, and we can afford to lose a limited small amount until this event eventually takes place on the downside. So our global macro fund has a negative downside capture ratio. What does that mean? It means on average, our fund in its 20-year history has made money in down markets, and I'm determined to be able to continue to prove that out, especially in this inevitable bursting of these bubbles that we still see coming. And I don't know when, but I do believe it is inevitable, and I do believe it's going to be coming sooner rather than later. So 20-year history are among all discretionary macro funds in the Preqin database. What this slide is showing is that our fund has not only the highest absolute return over that entire 20-year history, which is largely a bull market history, we still have the highest absolute returns. We can make money in bull markets too, but we bring the protection for the down markets where on average our funds have actually made money in down markets. I'm determined to be able to do that again. And we have both the best downside capture and the best absolute returns over that 20-year history. Let's go on to the next. So this is through September. Our funds, among all funds in the Preqin database, as of October 10th, when we ran this, we had 10. We had 5 of the top 10 performing hedge funds year to date. So our strategy has been working, and we have made money both on our put option portfolio, like we did back in February and April, in our global macro and long short funds. That trade is poised to work again, and we've made money on the long precious metals fund. Now, month to date, October, we are having a pullback. We're having a pullback because look at the GDX, look at the GDXJ. Our heavily tilted portfolio more towards exploration and smaller cap names is actually outperforming, and that's a very encouraging, these larger cap names, because earlier this year the large cap stocks had been outperforming the juniors, and it's nice to see when this market comes down that the juniors aren't getting slaughtered. Why? Because they're so cheap already. Now, so this opportunity to come in with market at all-time highs, that put option portfolio there and able to be positioned for a correction, and with the long activist metals portfolio, our largest theme across all our funds, our precious metals and institutional commodity funds are virtually solely dedicated to that theme. I think this time for investors who've been sitting on the sidelines to take advantage. And there are a lot of investors, as that survey showed, that are still sitting on the sidelines when it comes to gold. Yeah, you've been missing out, but this is your chance to come in on a pullback. No guarantee it won't pull back a little bit further, but I think there is so much more upside ahead.